Morning, Mo. How you going?
Morning, how are you?
Good, good. Look, I thought I'd ask you here to just do a quick video. Now that the New Zealand reporting season is behind us and we've seen a lot of results, we've heard from a lot of management teams. You always learn a lot about the economy, how corporate New Zealand is positioned. So I thought we'd just have a quick chat about all of that. And I guess the first thing I want to ask you is, we've seen a lot of volatility across markets this whole year, really, but these last couple of weeks, it's been all about Russia and the invasion of Ukraine. Now, the New Zealand market has actually held up pretty well compared to the likes of the US or Europe or some other parts of the world. And I guess on the one hand, that's maybe because we're far away from where that conflict is taking place. But do you also think the local investment community was maybe comforted by what they saw and heard through the reporting season? Would you describe it as a reasonably upbeat one?
I think so, and like you mentioned, you're going into this reporting season probably on unusual footing. You had rising inflation as a real pressure. You had the prospect of higher interest rates both here and offshore, and then you obviously had those geopolitical risks, which came to the fore sort of halfway through reporting season. But I think overall, I would think that most people would be happy with how our corporates held up. The share price movements were really unusual. Typically, a company will report a result, and if it went up or down on the day, you can kind of sort of glean from that if it was a good or bad result. But because there was so much macro sort of drivers, particularly around Russia, Ukraine going on, it was hard to decipher purely from those share price changes. But I think overall, we're certainly happy with the companies we follow and how they presented their results.
Yeah, and I mean, what would you give it out of 10 on balance? It felt to me like there was most results were pretty solid, pretty good. Most companies delivered and, on balance, were reasonably well. There's a few that were maybe a bit disappointing, but no complete shockers were there. So what is it a 6 or a 7 or a little higher? Where would you rank it?
Yeah, I think probably a 7. And the reason for that, I think it would be higher if the outlook statements were a little more positive. But given the backdrop that you've got, I think you come away pretty happy to have a 7 in the current environment. And remember, the results that they reported, most of these companies, are to 31 December. So, they're sort of 2 months out of date already. And so, while they were good, they're very much backward looking, and it's the outlook statements that are probably more important. And I think some of those were a little bit more circumspect, which takes a few points off that sort of out of 10 mark for me.
Yeah, that's a really important point, isn't it? Because for most of those companies that reported results in February or even in early March, we're talking about the 6 month period from the 1st of July through to the
Mm.
end of December last year. So, it's actually going back more than 2 months, isn't it? We're talking about sort of how are things going in, June, July, August, September last year, and in some cases. And the New Zealand economy was steaming along. It was full steam ahead. House prices were going up, unemployment was going down, activity was high, interest rates were still very low. So it was quite a buoyant period, wasn't it? And
Mhm.
now I guess maybe some of these CEOs and boards and management teams are thinking about maybe a few more challenges. So what are the things that they're worried about? Is Omicron and interest rates the usual stuff?
Yeah, I think it's all of those things, and it's an interesting point because the results were really, really good. The first half results, those 6 months were really, really good. You would normally see that translate into sort of upgrades to full year earnings guidance from a lot of companies, and we saw that with the odd one or two companies. But what we saw a lot of was really, really strong first half results and unchanged outlook for the full year. And you sort of sit back and think, well, geez, if your momentum continues into the second half, you're going to knock it out of the park relative to where your guidance is. But I think it comes back to, the supply chain disruptions that we're seeing, some of the cost pressures, the availability of labor, and Omicron is probably the big one. Aussie's sort of seen that wave, and New Zealand, while Omicron is here, we've not seen the worst part of it, I don't think. And we're starting to see corporates sort of feel the pinch on that now. And a great example is Freightways. They deliver your courier parcels to your door. In Auckland, they've gone into sort of a crisis level where they're only delivering absolutely critical sort of medical products and so forth. Everything else is going on a wait list. And now that comes down to just a basic factor of half their drivers in isolation or have COVID. So your workforce is halved overnight. You just can't deliver, and that's going to have an impact on the second half of your year, even if up to 30th of December you did reasonably well. And there's lots of cases out there like that where some of those challenges are going to come up in the next few months, and corporates just weren't, I guess, positive or confident enough to give upgraded guidance despite a strong first half result.
Yeah, because I guess if you're a leader at one of these businesses, their crystal ball's no better than ours or anyone else's, is it? So they're sitting there thinking, look, we've had a pretty good run, but now it's whether it's Omicron, whether it's the cost pressures, whether it's sort of the economy starting to slow a little bit as interest rates rise, or the housing market, maybe house prices come off, and that affects spending patterns or general sort of consumer sentiment. Plenty of things to worry about, isn't it? But I guess to again single out some positives, balance sheets always really important. Going into a potentially volatile period, we always want to see companies into that period with strong balance sheets, low debt levels, that sort of thing. Are you feeling that balance sheets are in good shape? And secondly, dividends. What have we seen in terms of dividends? Have we passed that period where they're suspended, they were cut, and now we're sort of back to BAU and a bit of dividend growth coming through? Can you just comment on those two things?
Yeah, look, there's obviously those external factors which, somewhat out of the control of these corporates, but the internal stuff, you've got to be impressed over the last couple of years of what New Zealand companies have done in terms of getting their balance sheets in order, reducing debt, cutting the sort of cost base, putting some big projects on ice, and as a result, they've got through the COVID sort of pandemic over the last year or two reasonably well. Yes, Omicron is still on our doorstep, but overall, those companies are performing well, and now that's translating into dividends because the balance sheets are strong enough to support dividends. And you're also seeing a lot of M&A, mergers and acquisitions, sort of takeover activity. You think about the New Zealand market, whether it's EBOS buying Life Healthcare, a big medical device distributor, whether it's THL buying their competitor Apollo, whether it's Scales out there looking, they got $80 million sitting in cash, burning a hole in their pocket. They're trying to buy something. You've got Freightways, while we talked about some of the challenges, they've bought Big Chill not long ago. So lots of M&A happening. Even the NZX bought the global dairy trade platform, or at least part of it. So lots of cash sitting with corporates, and they're not being lazy with it. They're putting it to good use. They're seeing the opportunities out there for growth and to make their own businesses bigger, and they're taking advantage of that. That's one side of it. I guess the other is dividends, and you're seeing the same there. Lots of companies paying some pretty healthy dividends. If I just, some of the ones where you saw sort of 10 to 15% increases in dividends in the last results, you had your Choruses, your EBOS, Freightways, Heartland Group, Mercury Energy. That's you wouldn't expect a boring old electricity company to be lifting their dividends that much, but they're paying bigger dividends. They've bought the retail business of Trustpower. They've bought Tilt, the renewable developer. They're doing a huge amount of stuff. They're building their own wind farms. So certainly we're seeing a lot of corporates that are flush with cash, and while there's short-term uncertainties out there, there's still long-term opportunities that they're seeing, and they're acting on that by putting that capital to good use, and either developing their own assets or going out and buying where they see the opportunities.
Yeah, good point. And if, just in case Vince Hawksworth from Mercury is watching, Mo means boring in a complimentary way, don't you? You mean predictable and defensive and steady and stable, like we expect from any good utility.
Absolutely, yeah. Boring's pretty good in our world.
Yeah, and yeah, I guess the lesson there when you talk about all of those examples, whether it's the M&A, whether it's what businesses are doing internally, no matter the environment, good businesses run by quality management teams will just continue to execute on their strategic plan, and they won't necessarily get hung up on what's happening in the here and now over this week, this month, even this year. They will continue to find ways to grow the business, and they'll see opportunities even amongst all of that uncertainty, won't they? So I think that's still something we should focus on. Look, we're nearly out of time. I'll just sort of put you on the spot at the end before we wrap up. I want to ask you to maybe like single out 2, 3 at the most companies that you saw as highlights, maybe through that reporting season. You've already rattled off sort of several companies that you obviously were impressed with, but anywhere just overall, what springs to your mind in terms of those two or three names that you thought were particularly impressive in terms of their results?
Yeah, and I would caveat that by saying there's probably a dozen that were really impressive, but so I'm certainly loath to pick out 2 or 3. But I think some of the ones that really impressed me were Contact Energy, again an electricity company which you wouldn't expect to be sort of shooting the lights out, just delivering good solid earnings, but they last year had a bit of trouble with their renewable energy. There was a drier year for them, so they didn't get as much hydro generation. Their geothermal plants were down. Those came back online, which meant those were firing on all cylinders, I guess. And what that meant was the thermal generation, being gas and so forth, there was less of that. Now, it costs you money to run your thermal plant because you have to buy the gas. It doesn't cost you much to run or cost you a lot less to run your hydro generation because the rainfall is free. So they had a really good result. And electricity prices were high during winter. They had excess electricity that they generated, and they sold that onto the market and made good money out of that. So that was probably one. EBOS is another one, again, one that's relatively defensive, but it's essentially a wholesaler of pharmaceutical products. And obviously with the environment we're in, there's more things being purchased at pharmacies and generally at doctors and things. So the wholesale business is doing really, really well. But quite contrary to that, they own a pet care business. So the Animates in New Zealand, if you shop at Animates, if you're a pet owner, then EBOS is part of that. Dog ownership, cat ownership, pet ownership in general has gone really, really strongly during COVID, and they're riding on the coattails of that. So that was quite impressive. And then I guess the third one would probably be Somerset. The retirement village sector has had a little bit of a hard time of late, purely around sentiment, but they came out and their earnings increased 40% in the latest half, and that was quite impressive. So they're seeing the buoyant property market, and they're leveraging that. And the important thing to note is Somerset raised their prices 3 times last year. And that culminated in 18% rise overall. But you look at a 2-bedroom standard unit at a Somerset village versus the median house price in that same area. If we look at Auckland, they're still 40% cheaper. And if we look outside of Auckland, they're still 20% cheaper. So while the result was good, I think the confidence comes from the fact that if we see a downturn in the housing market, there's a big buffer in terms of the discount, that Somerset operates at. And if we don't see a downturn, then you can see a path to actually raising prices further to get closer to the median house price that's in the regions where Somerset operates. And we've got an aging population. I think there's always going to be strong demand for retirement village operators. And likewise, we're like Ryman, they won't report for a few more months. They've got a different balance date, but that sector seems to be finally getting some wins on the back of the property cycle.
All right, thank you, Mo. That's a great wrap up. Look, just a reminder for listeners, when we have these sorts of conversations, we don't want you to take it as financial advice. We're talking more generally. We're talking about results that have happened, and that doesn't necessarily always translate to future performance. So just keep that in mind. We do always welcome listeners to come and talk to us. If you've got a Craig's advisor, they'll be more than happy to give you more information, more thoughts, more research reports on any of the companies that Mo's mentioned or any of the themes that him and I have discussed. Or you can go on our website, which is www.craigsip.com, and find out more about our investment advisory services if you do want some advice from us and you're not getting it at the moment. But for now, thanks, Mo. That's a great session. You enjoy your day. We'll wrap it up there.
Very good. Thank you.